Hi, I'm Steve LaFrance with Blakely Financial. Stocks are mixed to open the year. However, the general trend of large cap outperforming small cap, growth outperforming value, and U.S. outperforming international remains intact. Let's see what's happening. The S&P gained 1.6% in January, while the Russell 2000 traded down by 3.9%. 5 of the 11 sectors traded higher, mostly in the growth styles, where large cap growth returned 2.4% and large cap value gained only 0.1%. International stocks traded down 0.5%, while emerging markets were down 4.5%. Despite this mixed churning, the S&P, NASDAQ, and Dow Jones each set new all-time highs, mostly due to the companies with largest market caps and fueled by GDP growth of 3.3%, a solid job market, strong consumer spending, and declining inflation currently sitting at 3.4%. This led to the Fed holding rates steady after last week's meeting and hinting that rate hikes are finished for now. While both actions were expected, this confused the market as Powell stated that although inflation is moving in the right direction, he wants further confirmation that inflation will return to the 2% target before cutting rates. After seeing inflationary pressures ease over the past 6 months and assuming rates didn't need to stay at current levels of 5.25% to 5.5%, investors were surprised by this statement. What more does the Fed want to see? When can we expect the first rate cut? Well, the market consensus was beginning to consolidate around the idea of a March cut with ADP's recent lower employment report and a subsequent minor uptick in jobless claims. Until last week's BLS jobs headline of 353,000 knocked out those hopes. So we may have to wait a little longer, but it seems clear the Fed wants to initiate cuts this year as a proactive measure to support the economy. It's just a question of when and by how much. This will be welcome news for consumers with variable rate debts such as credit cards and mortgage seekers, but some experts are expressing concern that if the Fed loosens prematurely, inflation may escalate and become more entrenched, similar to what we experienced in the 70s, creating a situation far worse than recession. This is what they mean when you hear all the talk about soft landings, hard landings, or potentially no landings. To keep it simple, we anticipate they will cut rates if inflation continues lower, but keep rates steady if inflation proves stickier than expected. That's all for now. Take care of yourselves, and thanks again for your trust and confidence.